What steps can homeowners take to improve their chances of securing lower interest rates?
A couple things.
Mm-hmm.
First and foremost, manage your credit score. Know what your credit score is. Know who you owe money to.
Mm-hmm.
Stay current on it.
Welcome to Lawrence Real and Local, Keepin' It Real podcast, presented to you by the Lawrence Board of Realtors. We are your go-to source for all things real estate in Lawrence, Kansas. I'm Lexi Haskin with Flint Hills Mortgage.
And I'm Emily Robertson with McGrew Real Estate. Together, we're here to make the journey to homeownership a breeze. Join us as we share insider insights, expert advice, and a dose of fun along the way.
Welcome to Lawrence Real and Local, Keepin' It Real podcast by the Lawrence Board of Realtors. And we are joined here today by Kelsey McClasky with Fairway Independent Mortgage Company.
Welcome.
How are you?
Hello. Thanks for having me.
We're just so excited to have you here.
I'm excited to be here. I feel so professional, like a real life podcaster.
You are.
So I didn't say this when I walked in, but I actually almost wore pink too. So we would have been
We
just
could have
like
color coordinated.
That would have been fun.
it was just a pink episode.
That'd be cute.
Released it in October for breast awareness. Wait, isn't that breast cancer awareness?
Breast cancer awareness, yeah.
Yeah.
Is that October?
I think so. Yep.
Whew. Okay. Yeah, that was almost like yikesies. Okay. But yeah. So how'd you get into mortgages and just like give us a little bit of your background?
Absolutely. Well, I spent most of my initial career, about 8 years, working at Westar Energy, now Evergy, in key account management. So handling big clients' finances, construction projects, customer service, all of those things. Then I worked for a couple startups and really loved that. Liked being on the tech side, still was focused on customer success and on finance. Did a brief stint, almost 2 years at the Willow Domestic Violence Center as the Director of Survivor Services. And, you know, I was looking for a career change right after the startups. The work-life balance was not really what I was looking for, and I was just kind of ready to be more involved in the community because I was in Kansas City, commuting every day. And I had used Fairway and Diane for multiple of my mortgages, and it was the most pleasant experience. I've always kind of had a brain for finance and customer service. She always seemed like she was very happy with what she's doing. She got to be involved in the community. She and I had volunteered together multiple times, and I just kind of started picking her brain, you know, talk to me about what it's like to be a mortgage lender. And, you know, you seem to kind of have the lifestyle that I want in a career and in the community, and decided to take my test, and the rest is kind of history. So
The
That's
rest is
awesome.
history.
Yeah.
I love that story.
Yeah. And I mean, I love just hearing about when people just know what they want and they're like, okay, how do I get there? And just make it happen. And you did the thing, girl.
Absolutely. That's
Thank
awesome.
you. Yeah.
Well,
So we can go ahead.
I was going to say, well, today we're talking about interest rates.
Mhm.
Dun, dun,
And,
dun.
Just how to navigate them and maybe even just debunking some myths
Yeah.
about them that everybody just thinks.
Absolutely.
Yeah. So let's dive into our questions a little bit. Our first one is just going to be, how do economic and financial market changes impact the mortgage interest rates?
Yeah, so they definitely do. Things like inflation, cost of borrowing, bond yields, risk, things like that impact interest rates. They're also affected by personal finance factors, you know, your credit score, your debt to income ratio, things like that, your down payment amount. So it's a very nuanced thing. I think one thing about interest rates is people often think it's just cut and dry. Like, this bank has this mortgage company has this. Here I am banging on the table. Sorry, listeners. But it's very nuanced. It's individualized based upon that person and the program they're using and the purchase price and all of those things.
Mm-hmm. And then how does the Federal Reserve's monetary policy influence that?
Well, the Federal Reserve doesn't directly set mortgage interest rates. It does have the federal funds rate, which can kind of be a driving factor with mortgage rates.
Okay.
You know, if they're adjusting the money supply upward or downward, it can impact what's available for borrowers and at what rate. Typically, increases in money supply tend to push rates down, whereas decreases can drive rates up. And the best key factor, at least that I look at, and I think a lot of, Lexi, you can attest, is the 10-year Treasury is more of the the market mover and the thing to follow in seeing how it's going to impact mortgage rates.
And I liked what you were saying earlier, too, about how multiple things will impact it and how it's very personalized, because a lot of the times we will get those questions, what's your interest rate today? And you're like,
it's not that easy.
How much are they putting down? What's the term? What's their credit score like? It's not just a whatever.
Right. It's not just like today's 6.99. Get it while you can.
Yeah.
Yeah. And I mean, it's just crazy. And a lot of the times, even when those emails go out from lenders to people like, these are the rates, blah, blah, blah. And then you have to look down in the fine print and it's like, oh, but this person has X credit score. This person has, it's 20% down. It's just all those things.
Mm-hmm.
And people just don't take that into consideration.
Yeah.
I mean, I just had someone last week say, well, I saw that credit score, that the interest rate was this. Why are you telling me this? I'm like, well, your credit score is like 580. And
barely made the cusp. Yeah.
And so yours is a little bit higher. So that's just how I do just the risk.
Mm-hmm.
But yeah, a lot of people don't get that. And I like that you brought that up. But do you go over your rates? Do you send those out?
I do not. No. I think it's a very slippery slope. As you know, also with compliance, there's only certain ways you can phrase it. It, to me, can be misleading, and I would rather have that conversation with the borrower and be working with a fuller data set of what kind of rates we could get them, because, it's so nuanced.
Yeah, especially with what programs that they qualify for.
Yep, exactly.
Yeah.
Yeah, makes sense.
Just all the things.
All the things.
So, can you go ahead and explain the difference between the fixed rate and then adjustable rates mortgages, and then which one would be appropriate for home buyers in each sense?
Yeah, for sure. So fixed rate means you lock in that rate, and that is your rate until you someday maybe choose to refinance. Whereas with an ARM or a 2-1 buy down, there will be variance.
Mm-hmm.
And while it can get you a lower rate at the beginning, the fully indexed rate will likely be higher. And so that inserts some risk. And if you are a person that really needs to follow a budget, you like consistency, you don't want market volatility with it, fixed is the way to go. But if you are willing to kind of run the risk, you might end up getting a great rate. But it's really all about that. The other thing is, how long are you going to stay in the house?
Mm-hmm.
I think ARMs are really great for first-time home buyers sometimes, because they probably aren't going to be there that long.
Yeah.
They're probably going to move on. But it kind of depends.
And most homeowners, they'll move within 3 to 5 years.
Right.
Rarely anybody stays in there for 10 years or more.
Right.
You don't see people just staying in there for the full 30 years.
Yeah.
The thing that, at least at Fairway, we've had a lot of success with, and I've had a lot of buyers utilize, is the 2-1 buy down. Then that way, the seller is paying to buy down your rate for the first year and the second year. And the good thing is, if you refinance before that, then you still get that as a credit. So I really like that aspect. It seems a little less risky because you know exactly what year 1, year 2, and year 3 will be. It's not, going to fluctuate. So I've been a big fan of those as far as looking at adjusting rates.
Yeah, and getting that credit back too if you do decide to refinance.
Right, it's not money.
Yeah.
It's not a waste of money.
Yeah.
So I really do like that.
So our next question is, what steps can homeowners take to improve their chances of securing lower interest rates?
A couple things.
Mm-hmm.
First and foremost, manage your credit score. Know what your credit score is. Know who you owe money to.
Mm-hmm.
Stay current on it. I know Credit Karma is a great service in many ways, but their credit scores that they give buyers are going to be different. I'm sure you see it too, Lexi. They usually have much higher scores with Credit Karma than they do with an actual mortgage poll that looks at a different FICO mix. Credit utilization is really important. Length of credit, that 30% utilization rate, and making sure you're current on it. Don't let anything get into collections. And if it does, I know sometimes, and this is something that I do have a conversation with buyers a lot. They're like, well, that's Sprint's fault, or that gym tried to charge me for months that I had canceled. And trust me, I stand on principle and things like that too. And sometimes it's right and wrong. But is it worth impacting your ability and your buying power to fight a $300 bill and let it go to collections when it's going to stay on your credit report for a long time? So making sure you keep all those things current. And, if you don't have credit, you need to get a credit card. In my opinion, the way we handle credit in America is a little backwards. Like you pay everything on time and don't have a ton of debt. You don't have as strong a credit score as someone with 7 credit cards and more debt that's current on it. I mean, I get it, but we want to know your credit worthiness and that you have been known to be someone worthy of extending a line of credit to, that you will pay it on time and regularly. I would say one of the biggest things definitely is managing that credit, making sure you have a good down payment. At least 5% is a good rule of thumb, in my opinion. And just being ready to also cover closing costs. I think that's something that's a little unknown to some folks, that it's not just your down payment. There's also going to be cash to close and closing costs and things like that. So I always recommend, even if you're not looking at buying now, maybe it's a year and a half away, talk to a trusted lender who could put together kind of a path and a budget of what you can expect. If you're looking at this price range, what would your payment be? What would your closing costs be? And things like that. So you can kind of work towards that goal with a clear vision.
Yeah.
Yeah, that was a good explanation. I like that.
Also, going back to the credit, too, I mean, if you do want to check your credit report, you can do it for free one time a year. And isn't it annualcreditreport.com or something like that?
Or org.
Or
I can't remember if it's org or com, but
I can look it
one
up.
or the other.
Yeah, that's a good resource. I like that.
Report. We are a .com.
.com.
Annualcreditreport.com.
I'm glad it's not
I like it.
.net.
Yeah. And I mean,
those are getting phased out.
And even with people that don't have credit scores too, I mean, there are some loan programs or lenders that will do it with no credit score, but it's very, very difficult to find.
Correct. Yeah. We've had some that, you can let your Netflix account count towards it. And, but it's a complex thing and it's not guaranteed you're going to be able to get it. I strongly suggest getting established credit.
Yeah. Because I mean, with the alternate ways of credit, whether it's like utility bill, Netflix, phone bill, I mean, you have to have 12 months of that in order to prove that. So,
yep.
But
one other thing, sorry to interrupt, one other thing I would note too is with self-employed borrowers, obviously we want to claim as much as we possibly can, right?
Yes.
You don't want to pay more taxes than you need to. Who would want to? That's crazy. Like, it's my money. But if you're looking to buy a house, your income on paper matters. We all know tax write-offs are a way to help your tax burden, right? Yeah. But when you're looking at buying a house, you need to show that you have a strong income and a consistent income. So I like to work with self-employed borrowers, just kind of a plan for that. Like last year you claimed this much, if you're looking to buy in 2 years, maybe this is how we approach it with your accountant. And even looping in the accountant.
Yeah. Like, I make $300,000 a year. I'm like, well, actually.
Well, you claimed 40 grand.
And if we're averaging this out over 2 years, we actually can only use this amount.
Right. Yeah, exactly.
So it's just a lot of things.
Yes.
Oh, my gosh. Well, okay, well, we already talked about that. So what is APR? What does it stand for? And is it accurate when you're comparing lenders? Yeah,
so APR often can be confused with interest rate, but they're very similar. The difference with APR, which is annual percentage rate, is that it also includes additional fees, origination fees, things like that. So it's more of an all-encompassing rate, but interest rate is a pretty good rule of thumb to go off of.
Can I just say something on the other side of APR?
Absolutely.
So I did do some research on APR and how it can be misleading. And so with it being misleading, it's just assuming that everybody's going to have that loan for the entire life of the loan. That they aren't going to refinance. They're just going to stay in that loan the entire time. And that's inaccurate. And then different lenders will have different fees that they will count in the APR. And
Right.
so then it's like, that's not accurate.
The calculation of the APR that's presented can be calculated with different factors. So
Yeah, you can have the same loan terms from lender to lender, but then if somebody's giving you a loan estimate on June 1st and then somebody's giving it to you on June 30th or June 15th,
exactly,
then it's going to be different. But the loan terms were exactly the same, but the mortgage interest that you're prepaying is counted towards that. So then it's like, well, you really are getting the same loan, but just on a different day. So, I mean, I just don't think it's very accurate when comparing it. Everybody's like, APR, look at the APR. It's not. Yeah.
I'm glad you came out and said it because I was kind of tiptoeing around that.
You're like, look at the interest rates.
I'm like, just look at the
just
interest
look at the interest rate.
Well, and I mean, I'm sure you've seen this, Lexi, like the fees amongst lenders in town don't vary very much. You know, like it's not like you're going to go one place and it's $4,000 and the other place it's $1,000. Like we're talking hundreds in difference, minimal hundreds in difference. So I think that's something too. I think people think there's going to be this huge variance, and for the most part, there really isn't.
I mean, honestly, like any lender that you go to in town is pretty great to work with.
Absolutely.
We're really blessed here.
Absolutely.
Yeah, we really are.
Just whoever you jive with.
Yeah.
Right?
Oh my gosh.
Okay, we'll go for our next question. How can potential home buyers accurately estimate their mortgage payments considering factors beyond interest rate?
So shameless plug, you could download the Fairway Now app that has a built-in calculator.
Yeah.
Pretty accurate. You'll find tons of calculators online. For the most part, those are just looking at your principal and interest.
Yeah.
But if you have a specific property in mind, you can go to the Douglas County property search, see what they've been paying for taxes, divide that by 12. That's what's going to be added monthly. You can get an insurance quote from whoever you use for insurance, just to kind of understand what kind of rates you could be getting. You know, it is particular to the house, but it's also particular to the insuree. Yeah. So I think those are good ways. But honestly, talk to a lender, talk to a trusted lender.
Yeah.
There are so many, I've used the word nuance like 20 times, but there are so many nuances to all the factors and what program would be best for you. You know, like you can estimate a payment, but do you know if you're better with FHA or with conventional or with an ARM? Like it's just, there's so many layers to it that I really think talking with a lender, even if you're just looking at it far in the future, it's going to benefit you.
Absolutely. And not trusting like the online search sites that'll just say like, this will be your monthly payment probably with no information.
Right. Not knowing Lawrence, Kansas and tax rates and things like that.
Yeah.
So
I know that there are also some title company apps that have like the taxes and insurance estimate that people can download as well.
Yeah. There's a lot of good ones.
Yeah. But again, it's not as accurate as if you were just going to go to the county website and look it up. And I will say that I have noticed insurance quotes going up quite a bit over the past couple of years. So, I mean, even just talking to an insurance agent, like you said, just get that quote. I mean, that would definitely be very beneficial for that person.
Yep.
Absolutely.
Especially insurance, depending on the age of the roof.
Yeah.
That factor alone can be a huge, huge driving factor in your insurance rate.
Yeah.
Yeah. It's almost like, say, give me worst case scenario.
Yeah. And then I'll work back. Yeah.
Yeah.
And then we can go from there. But yeah, I mean, it's wild.
Absolutely. So our last question, we kind of talked about this a bit. Are interest rates the only thing people should consider when choosing a lender?
Well, to quote my friend Lexi, who do you jive with?
Yeah, I like it.
You know, I mean, we're going to be in your business for 30 plus days and you're going to talk to us regularly. And if you don't vibe with that person and you don't like the way they communicate or you, you know, need different availability from them, that's really, really important is people you like. A strong operations team. Does this lender have a reputation for closing on time every time, even early, things like that? You know, what's the support after closing?
Yeah.
Is it we're done Or is this someone you can call and ask questions about in the future, 3 years later?
Yeah.
And that's something that, you know, I love to provide to clients is like, this is a long-term relationship. This isn't just for this transaction.
Yeah.
Yeah. Like
I want to be
a
your trusted advisor.
Yeah.
You know?
Absolutely.
There's reviews that people can go and look at too.
Absolutely.
Yeah.
Google reviews or the lender website. Word of mouth. Who have your friends used? Who did they enjoy?
Yeah.
Who does your realtor like working with? Who do they think is a good fit for you?
Yeah. Who do you feel comfortable just asking questions to?
Absolutely.
That's a big thing. Yeah.
Because a lot of realtors in town, they know us. They know like what our personalities are like, and they can be like, well, I don't think necessarily that person would like working with that person.
Probably not the best fit, but
maybe I'll send them over here.
we'll go there.
Yeah. And it's great. And then too, if a lender doesn't have a program that works for that borrower, and they know we don't have a problem referring them over to somebody else, and just saying, hey, we don't have the best thing for you. Let me reach out to blah, blah, because we really want what's in their best interest.
Right. Fairway does not lend on land. There needs to be a structure on it. But we have other folks within the community we refer to. We're not upset about it. We want you to be with the person that can help you achieve your dreams in the order in which you want to do it. You want to buy land and build? Great. Here's that path. You know, you want to buy an investment property? Here's this path. I think it's actually really great kind of smallish town network that we have. I think all the lenders really respect one another. And there's room for all of us, and we all bring different things to the table.
Absolutely.
Yeah. Too, like I don't do portfolio loans because I'm not a bank.
Right.
Yeah.
Same.
So it's like, oh, you need this certain product? Okay, let's go over here. Like, you need a bridge loan? Okay, let's go over here.
You want to use the equity in your current house towards a down payment on that? We'll send you here. That's not our realm, but that's okay. We have other products that other banks and institutions don't have. So
yeah.
Yeah.
Sometimes it is good to just be a master of like a couple different things. Not jack of all trades, master of none.
Exactly.
Yeah.
I completely agree.
Yeah. I will say for a while in college, I was really dabbling in a lot of different hobbies. And my dad would say that to me and say, Lexi, you are trying to be a jack of all trades, master of none. I'm like, I don't know what you're talking about. I'm a master of all.
The confidence is there. I love it.
It's awesome.
But hey, nothing wrong with trying like knitting and cooking and gardening. I'm not good at gardening, but I saw that you got some pretty flowers recently.
I'm a big fan of landscaping and flowers and plants for sure. But knitting and crocheting, it's as if my hands don't work. I can't
do it.
I'll admit I wasn't good at that. I can only finger weave.
Wow.
Stop it. You did finger weaving? Did you watch the Jimmy Kimmel with Emily Blunt?
But Kelsey, I literally have like a giant ball of finger weave that I did from like
the
grade
pandemic
school.
Oh no, okay.
And my sister and I literally unrolled it blocks. Like it goes very far.
Right, because it's the long.
Yeah,
you can only make the like snake of it. That's the only way I know how to do it. And you're. Boop, boop, boop.
Yeah, but then you can do it with all four fingers too. Yeah, but we have. Seriously, an entire ball. I'll send you a picture of it.
I will
when
send
I get
you a
home.
picture of my pandemic finger weaving. My husband finally had to be
like,
it is mesmerizing. It's so soothing.
I have to try that.
It makes
Yeah.
The piece it makes is not worthwhile. Like you can't turn
That's
it into
fair.
a.
It's like
you
a
could
fidgety
probably,
thing. Yeah.
You could probably like put some into a pot holder or
scarf.
something. Right. Like a very skinny like little tie.
Like
I like
a
it.
skinny headband.
It's a bolo tie.
Maybe just do like little earrings.
Yeah, my husband was like, so all these little bands we have all around and these snaky strings of finger weaving, like what's the ultimate goal with this? I was like, entertainment.
Yeah.
You're like, this is just it. I mean, maybe we should have been finger weaving while this podcast is going on. It could be a little...
That'd be amazing. I'd love that.
I
add an extra layer.
I literally talked about finger weaving to so many people and no one knew what it was. And they're like, I don't think that's a thing. I was like, yeah, it is. And it's fun.
Okay, well, yes, I completely
Can we
know
finger weave at some point? Like,
Yeah, girl, I'll finger weave with you anytime.
This is a
Matt, I'm sorry. I'm sorry, Matt. It's coming back into life.
You're like, I just found a finger weaving buddy, so
That's
there.
awesome.
Oh my gosh, that's so funny.
I found it because Emily Blunt was interviewed on Jimmy Kimmel, I think.
Mm-hmm.
And she was like, John Krasinski, when he was making A Quiet Place, like got really into it. And it was just this like zone out thing. And like she was doing it the whole interview. And I was like, that looks so fun.
That's awesome.
And it is. It absolutely is.
I love
If you
it.
go really fast, though, it can give you like a little yarn burn a little bit. Has that ever happened to you?
So the ones I used were like Jersey. We are completely off topic.
Oh, no, that's
but I'm enjoying it. I could talk about finger weaving forever.
Okay, yes, guys, sorry. A little lender finger weaving diversion
Yeah.
to
Yes.
add a little extra to the episode.
I love it.
And to our editor, Josiah, you're welcome for this little... I don't even mind if we leave that in.
I
like
don't
it.
either.
Yeah.
I think it was good.
You know what? You guys are learning about interest rates, lending, and finger weaving.
Yeah. The whole package.
We'll
Learned
change it.
something new today, didn't you, kids?
Well, do you want to get into our facts or fiction interest rate edition?
Sure.
Let's do it.
Let's do
Okay.
it.
Okay, I'll go for it. Okay, the first one. Interest rates are solely determined by the Federal Reserve.
Fiction.
Fiction. Higher interest rates always mean higher monthly mortgage payments.
Fiction. And I'll say why, because how much are you putting down?
Mhm.
What's your loan amount?
Yeah.
Like it's going to impact your payment. Interest rate is a
Yeah.
piece of the puzzle.
And if you
I
have
like
mortgage insurance,
Yep.
how much is your mortgage insurance?
I like it. Locking in an interest rate guarantees that it will not change before closing.
Fact.
Fact, nice. Shopping around for the lowest interest rate is the most important factor when choosing a mortgage lender.
Fiction.
Nice. Adjustable rate mortgages are always riskier than fixed rate mortgages.
I'm going to say fact
Mhm.
on that just because there's risk.
That
There
makes sense.
could be reward with it, but
It could pay off, yeah.
it could pay off, but it could not.
Absolutely.
I find them to be riskier.
I can't remember. What is that one term? So, I mean, we have the sheep and the lion, but then with it, like when it comes to risk with mortgages, I can't remember. It's like the bear
Bull market.
and the,
Bull market.
yeah, okay, yeah.
I like the movement.
That was good. I'm glad this is a video
I was like,
podcast.
there was like one where it like went up like that, and then there's another one where they were like this. But I
love
remember
it.
that because that's what a bear looks like. So I was like, okay, that's a bear, but I can't remember what the is. Okay, bull.
It's good. I like it. Funny.
Reminds me of dodgeball.
Yeah.
Taking the bull by the horns.
Oh my gosh. Okay, Kelsey, if you could just leave the listeners with one thing
Mhm.
or something that we didn't touch on, just or wanted to say, pound, 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 this is what you need to just drive it in. What would you say?
I would say find a trusted lender, talk to a few. We're happy to, even if you're not looking right now, we're happy to talk you through the process. Like, don't go into it completely uneducated. Learn, take care of that credit. And Lawrence is the best city in the world.
I love
Does
it.
that count?
Yeah, that was great.
Yeah.
All right.
Awesome. Thank you, everyone, for listening today. And thank you to our sponsor, Flint Hill Mortgage.
Thank you. Thank you.
Yeah. And thank you to the Lawrence Public Library for letting us use their podcast studio. We absolutely love it.
I'm Lexi,
I'm Emily.
And I'm Kelsey.
signing out.
Bye.
Thanks for joining us on Lawrence Real and Local, Keepin' It Real podcast. We appreciate our guests taking the time to join us. Don't forget to subscribe and leave a review if you've enjoyed today's episode.
For more information, please visit us on the web, www.lawrencerealtor.com. And remember, whether you're buying, selling, or simply dreaming of your future home, we're here to help. Until next time, keep it real.
And happy house hunting!